A stock represents a fractional ownership stake in a company. When you buy one share, you own a tiny fraction of that entire business, including its assets, its earnings power, and its future growth potential. Companies issue stock to raise capital from the public, and investors buy that stock expecting the business to grow and their ownership stake to become more valuable over time. Think of it like owning a slice of a pie. The bigger the pie grows, the more your slice is worth. When a company profits, stockholders benefit through rising share prices and sometimes through cash distributions called dividends. Stock exchanges like the New York Stock Exchange and Nasdaq are the regulated marketplaces where buyers and sellers meet to transact every trading day. Prices move continuously during market hours based on the real-time balance of supply and demand from millions of participants simultaneously. When more people want to buy than sell at a given moment, prices rise. When more want to sell than buy, prices fall. This dynamic plays out in milliseconds across every trading session. Bull markets are extended periods of rising prices driven by economic growth, corporate earnings expansion, and investor confidence. Bear markets are extended declines driven by economic contraction, rising interest rates, or widespread fear. Learning to recognize which environment you are in shapes every decision you make as an investor. Companies enter the public markets through an initial public offering, or IPO. Before the IPO, shares are held privately by founders and early investors. After the IPO, anyone can buy or sell those shares on an exchange. A stock quote shows you the current price, the day's high and low, trading volume, and the change from yesterday's closing price. Reading a quote fluently is the first practical skill every investor needs. Dividends are periodic cash payments some companies make to shareholders from their earnings. Not all stocks pay dividends. Growth-focused companies typically reinvest all earnings back into the business instead. Major indices like the Standard & Poor's 500 track baskets of leading stocks and give you a benchmark for measuring overall market performance. Diversifying across many stocks reduces the damage any single company's failure can do to your portfolio. And compounding, reinvesting your gains year after year, is the most powerful long-term wealth-building force available to any investor.